All right, well, the bond market is rebounding just a bit this morning. When you take a look at the yields, at least pulling back to just around 4.8%. This comes as speculation rises that maybe the recent sell-off may have been a bit overdone. Now, billionaire investor Bill Ackman saying on Monday that he's getting out of his bet against long-term government bonds, saying in a post on X, quote, "There is too much risk in the world to remain short bonds at current long-term rates." Now, as yields pull back, equities are getting a little shine with the tech-heavy NASDAQ leading the march higher ahead of Microsoft and Alphabet earnings after the bell today. So can these tech earnings live up to the hype and turn the markets around? For more on that, we want to bring in Young Yuma. He's BMO Wealth Management Chief Investment Strategist. It's great to see you, Young Yu. Let's talk about the latest dynamic right now in the market, because yes, a lot of the focus later on today is going to be on the tech earnings that we'll be getting from Google and the results that we'll be getting from Microsoft. But pairing that with the movement that we've seen in the Treasury markets as of late, how does that set us up here for the final 2 months of the year?
Well, there are a mix of risks going on right now. I think that's what the market's grappling with. We don't know where bond yields are going. There is two-sided risk. I think there's still some risk to the upside if the geopolitical concerns kind of wane a bit here. But there's also risk to the downside for yields if some of these concerns become more acute. So I think that continues to be a driver as well. But what happens with earnings, tech earnings certainly are going to be a big deal. That's carried the market this year, and there's going to be an intense focus on these earnings to be able to kind of lead the way as the generals in the market here.
It's carried the markets because of the expectation that AI would also be a major contributor to some of these companies' future financial performances, that getting priced into valuations. Do you think that we're overstretched at this point? And if so, are we expecting some type of rug pull?
I don't think we're overstretched. I think the market certainly has high expectations for these companies, but in terms of the future prospects and how AI plays into that. But I don't think they're overdone here. I think there is great promise. I think these mega cap technology firms are very well positioned to capitalize on trends going on, and the strength that they've had previously, I think, is going to continue into the future. So there is an element right now where deep pockets and strong market power is certainly adding to their prospects going forward, and I think that'll continue to be the case.
So do you think then, I guess, these earnings results maybe hold heavier weight with the market's at least short-term direction right now than the massive rise that we've seen in yields? Is that right?
Well, I think both are in play, right? Both are in play. I think as long as yields are not rising, if yields, the 10-year Treasury yield, for example, stays stable where it is, then I think there can be a renewed focus on earnings, what the trajectory is for these mega cap tech companies and, of course, other companies in the economy. But if yields start renewed climb, that's a sharp turn upward, then the focus can shift a bit. That's what we've seen in the marketplace, is really abrupt shifts in terms of the market narrative. And right now, I do think the yields are kind of a two-sided market. We actually increased our duration in our fixed income portfolios just the other day as well, to take a neutral duration rather than be short duration, because we do think there's two-sided risk now to these longer-term Treasury yields. But it's important for them to stay stable. If they continue to climb as they have been for the past few months, that certainly will pressure the markets here.
Are you confident that they are going to stabilize? And I guess if not, we've talked a lot about the volatility, everything that is at play that's pushing yields higher here. If we do break back above that 5% level that we briefly crossed yesterday, how high do you see yields climbing?
Well, we do think that the geopolitical risk, combined with what we actually expect to be a slowdown in the coming months, an economic slowdown, we think some of the forward-looking data, some of the survey measures, some of the strains on consumers, at least among certain groups of consumers, we think those are starting to come into play. And we think the higher interest rates are starting to bite in terms of constraining the economy a bit more. So we do think that yields probably around here, the 10-year Treasury yield faces headwind, a lot of headwind from going higher, not just geopolitical concerns, but probably a slowing economy over the next few months or maybe a couple of quarters. So, we don't think it's likely that we'll go much past the 5% level. There's a lot of Treasury supply. The other side of that story is just massive supply that has to be absorbed in the market. And exactly where demand meets that supply, it's a little bit tough to know. But we think with the geopolitical concerns combined with slowing economics, it probably meets supply right about where it is now.
How restrictive do you expect the Fed to continue to be?
We don't expect the Fed to raise rates again. We think that the Fed is probably at peak hawkishness right now. We don't think it's necessary to raise rates again. The interest rates and the quantitative tightening that's going on, along with bank lending standards tightening, along with deposits leaving the banking sector, all of this is adding to restrictiveness, a lot of restrictiveness in the economy. So we think the Fed is going to recognize this and is recognizing this. And as soon as we start to get soft data, which we think is probably right around the corner, the Fed is going to see it doesn't need to raise rates anymore.
So what do you like in this environment? We've already talked about tech, how much is riding on these earnings reports here over the next couple of days. Outside of tech, where are you seeing the opportunity?
Yeah, that's a big caveat outside of tech, right? Because tech has certainly been the stalwart this year and probably continues to gain a lot of attention and is a space that should do well. Outside of tech, we continue to like U.S. infrastructure. There's been a bit of a pullback. We think that the money going into infrastructure is going to be substantial for years to come. So we do like companies that play into U.S. infrastructure, or even an ETF that plays into U.S. infrastructure. That's probably the next most favorable area for us, actually, besides technology.
Young-Yu Ma, BMO Wealth Management Chief Investment Strategist. Young-Yu Ma, pleasure to begin the day here with you. Thanks so much for taking the time.
Thank you.